let's get started. Let's do just a real quick audio check and visual check. Moderator, if you can hear me. Okay, good, excellent. All right, so let's just, before we get started, do a quick recap of what we've talked about for the past, 13, well, I think, yeah, about 13 webinars. And then we'll go through why I think the next three or the last three webinars that we have scheduled here are in my opinion, going to be by far the most important. Okay, so let's discuss this slowly, and I want to make sure this makes sense. Why I think this is the most important. Why this is the most important part of the webinar series. So, first of all, let's just kind of talk about, again, the recap. I like to always make sure that we understand where we're coming from and how we got here. And you know, when we talk about the U.S. stock market, it's, you know, we've talked about the importance of understanding the liquidity, the importance of liquidity, the importance of transparency in the stock market and in any markets really, and then the stock market does offer that. Now, the other thing that the stock market offers, the U.S. stock market specifically, and well, actually all stock markets do, is a defined set of time. So you know exactly when the market opens and when it closes, and that actually is a serious advantage. And you know, just want to quickly make this contrast versus currencies noted. You know, it's important to understand that, yes, you know, what a lot of people are attracted to trading currencies because of the fact that they can be traded, you know, basically 24 hours a day. But inherent to that fact, and what seems like seems good on the surface, are also some inherent catches. And again, you know, one of the main catches to me when we talk about currencies is not that you can't make money with them. You certainly can. It's that you need to find a specific spot and a specific strategy to make money. And a lot of people just kind of dabble any time of day. They try things left and right, and a lot of that is due because they have essentially unlimited. You know, the market is open 24 hours. So the great thing about stocks is that again, you know, they are open a specific amount of time and not unlimited. And by the way, just so you know, I opened up a trade in Cisco Systems live here a few webinars ago, and you can see we're now making some nice profits already on that trade. We're going to just quickly flip over to that to just quickly make sure I don't forget to highlight this. CSCO is the ticker symbol. We opened that trade on I can't remember the date now. I should see it here somewhere. Anyway, and it's been a nice rally since in Cisco Systems. So you know, the point why I'm trying to telling you this is that you don't have to be a hectic trader in order to make money. This is a trade that we opened, you know, I don't know, at this point, it's probably 2-3 weeks ago. And you can see this, the trade is acting very, very well. There's no reason you don't have to be looking at the stock market, you know, 8 hours a day or 10 or 12 hours a day. In fact, I think it's detrimental to one's success. So anyway, those are some of the advantages of the stock market. Those are some facts about the stock market. Again, you know, very defined time, liquidity, and all that stuff. Now, what we're going to talk about today, and again, what I said earlier, I believe this is going to be by far the most important part of the webinar series today, Friday, and then the following week on Wednesday again. And the reason I say that is because what we're going to do now over the next 3 days is I'm going to walk you guys through an actual analysis session, the way I look at the stock market every single day. And just so you know, I don't spend more than probably an hour and a half most each day, probably less each day in front of the computer actually looking at the market live. A lot of times I'm on the go. I have meetings I actually just came back from a meeting, and I was on like a tram, like a train kind of thing, and I was looking at the market and executing a trade. And again, you can do this stuff from anywhere if you have some software on your phone, on your iPhone, your smartphone, whatever you have, on your laptop. So you can do this from anywhere. But the important thing is that you have a rhythm, a routine, and that's what I'm going to show you guys today, Friday, and next Wednesday. And I think this is absolutely imperative. I can't overstate how important this is. So without any further ado, let's talk about this. Okay. So let's first of all bring up the S&P 500 just so we have something to kind of talk about here as a reference point. But what I would like to do, more importantly, I'm going to see. I don't know if this is possible to move over more. I guess this is the maximum. Anyway, let's focus on this part here of the screen. And what we're looking at here is something that we've talked about before, but something that we need to now elaborate on to make sure you guys understand, or at least I do the best job possible to explain to you what these watch lists, or what this watch list is and why it's so important. Okay. Now, I have different types of watch lists. My watch lists don't just include these few tickers, but these few tickers are extremely important. And these few tickers, and they're in no particular order here, although I do usually like to rank them by percentage change, okay, which is something that, okay, it doesn't seem to, oh, I guess you can do it like this. Let me see how you can do that. Okay, doesn't seem to want to change that way. Anyway, what I usually like to do is rank these in percentage change terms. I know you can do it. I've done it here. I just can't remember right now how to do it, but it doesn't matter. You can see that today is actually not so important because most things are kind of choppy, except for transportation stocks, which we will look at here. Just so you have something to look at, are a little bit more under pressure than everything, which is actually quite interesting to watch. So anyway, so what these tickers represent are the sectors, essentially, of the stock market, okay? And I'm going to quickly walk you guys through them. We've touched on them before over the past 13 webinars. It seems like it's been quite a journey already. But let me walk through them one more time with you guys in more detail, and then I will explain to you guys after that why each one of those sectors are important to watch, how to watch them, and then we're going to look at the market in real time. I do think actually the market is very overbought here, so actually looking for a pullback. So anyway, just so you know, that's what we're going to do. So let's start off with the big one. And again, I'm going in no particular order. I'm going to probably just going to go down the line like this. But obviously the S&P 500 represents large cap stocks in the United States. And this is really an important part of the market, and really the benchmark against which many portfolio managers are pegged. The benchmark for risk on, risk off. What does risk on, risk off mean? Well, risk on usually means that when stocks go higher, when risky high yield bonds go higher, anything that is a risk on trade is something that usually tends to go up when things are good. When things are less good in terms of economically speaking, then you tend to see risk off environments where stocks go down, bonds go up, bond prices go up, bond yields go lower. You tend to see usually a mixed bag in commodities, although you would usually see some sort of a bid in commodities, and the dollar index is, or the dollar specifically, the U.S. dollar is just a little bit away from that, but tends to be mostly something that rises when the broader stock market rises. So anyway, by the way, just so you know, I just received, and I'll excuse me for jumping back and forth a little bit, but we are now going to be doing live analysis, which is very, very important. So I did set an alert on my trading platform that I want to watch NVIDIA. I bought a little bit of NVIDIA again, actually just before we started the webinar, and you know, again, it just now actually triggered a trade automatically. I just got an email on it, not on this demo platform, but nonetheless, just so you know, that's what happened. So in full transparency. On the 5-minute chart, you can see why I basically liked the stock to push a little bit higher above resistance. So anyway, here it is right now. So let's walk through these tickers here so you guys can see what we're looking at. Yeah, so actually that's a good idea. So ABC Trader, we'll talk about TLT in a little bit. But TLT is a risk-off asset. Yes, I mean, again, you know, the correlation between bonds and stocks is always a little bit different. It's never, you know, there's never exactly inverse or direct. But there is plenty of to be said about you know, using bonds as a proxy for risk-off. So it's, you know, you can certainly look at it. So let's have a quick look at TLT first, and then we will go through what I just said. So personally, to me, you know, I don't see a reason to buy on a day like today, because if we're not breaking anywhere, we're not having any bullish reversals. Again, that's a matter of style, right? TLT is lower for the day so far. Personally, you know, to me, it's stuck in a range. It's very choppy. I would need at least a push above 121, but you know, that's just more my stylistic approach. That's not to say that, you know, you can't buy it here, but I personally would certainly wait on that. Anyway, so let's talk about this whole spiel. So we talked about the S&P 500 as being like your benchmark index. Large cap stocks is, of course, what this represents. Then we can look at the IWM, which is the Russell 2000, also something that we have discussed quite a bit already over the past 13 or so webinars. We're actually, you know, had a very nice breakout out of the Russell 2000 a number of days ago. So small cap stocks are important to watch, and again, I'll explain why those are important all in a little bit. So those are two things on the watch list, and I'd like to look at the industrial stocks. This is just a sector in the S&P 500. Material stocks are important to watch. Those actually look like they could break out pretty soon again. Utility stocks are important. They're actually a risk-off trade, or a risk-off sector. They act like bonds. Then you have XLK, which is technology stocks. Okay. Then we have the XLP, which is consumer staple stocks. IYT represents transportation stocks, and you can see they are dramatically underperforming the broader market today. We'll talk about that more in just a second. Energy stocks is the XLE. The XLY is consumer discretionary stocks, and XLF is your financial stocks. Okay, so let's walk through this step by step and kind of what these different parts of the market do. So starting off with the S&P 500, we talk about the S&P as being a benchmark. It's also important to understand that the S&P 500 is something that's being followed on a global scale, you know, incredibly much. So, you know, you have like 10,000 hedge funds around the world that follow the S&P 500 and try to make money from it on a daily basis. And so the S&P 500, as much as it actually acts very well technically, it can be something that that can remain irrational for quite a bit longer than what people would like to admit to. But the S&P is an important index to watch, so we do want to watch it all times. Now, the Russell 2000 is a small capitalization index, meaning these are stocks or companies that have smaller market capitalization than the S&P 500, because the S&P 500 is large cap stocks. And the reason we need to understand the relationship between the Russell 2000 versus the S&P is that small cap stocks tend to, okay, and I say tend to, have a leading indicator quality to them. So ABC, if you're asking me this question about a good indicator to identify risk on, risk off, this is one very simple, but I believe an effective way of looking at it. The Russell 2000 does tend to, and again, this is a tendency, it's not always like that. Of course, it's not always like that. But there is a tendency for the Russell 2000 to outperform the S&P 500 on a leading basis on the way up, and to underperform the S&P 500 on the way down. Okay, so those are two ways of or that's one relationship, I should say, that I think is very important to watch. But there's not one simple indicator. It's always an amalgamation or a combination of different things that need to take place in order for us to get an idea of when we're moving from a risk on to a risk off environment. Okay, so this relationship between the Russell 2000 and the S&P 500, in my opinion, is very important. Then the rest of these tickers here, again, they mostly represent sectors of the S&P 500, except for the IYT, which is a group in the S&P 500. It's not an actual sector. But what's important to understand is that a lot of these different sectors, they will move according to either, well, first of all, they certainly move in accordance with what the broader stock market is doing, right? So the S&P 500. But also, they will move in accordance to what they're exposed to. So, for example, the financial sector, the XLF, is exposed to arguably more than any other sector to the level of interest rates. This is at least what I think, and this maybe some people would argue this may be a bit different, but you'll see the idea. The XLE, this is energy stocks. These guys are extremely sensitive to the underlying dynamics of something like energy prices, like the price of oil, for example, right? So even though these are stocks, they are very sensitive to the underlying asset there. And we have things like transportation stocks. These are good, really good risk on, risk off fields as well. The transportation stocks, do in a healthy market, the transportation stocks have to at least not go lower, okay, if the broader market goes higher. So the transportation stocks are a key component. Then you have things like consumer staple stocks, okay, that's the XLP. These are kind of like your boring stocks like Kraft and, and I shouldn't say that we use the word boring, but the stocks that, companies that are less exposed to the cyclicality of the markets, because their products will usually get bought more or less the same amount regardless of whether the economy is doing well or not doing so well. So for example, milk, most people will buy milk regardless of how well the economy is doing. Most people will buy bread regardless. Most people will buy Coca-Cola probably, and so on and so forth. So these are the consumer staple stocks that usually tend to do well. So if you have something like consumer staple stocks and utility stocks going higher, and let's have a look at them today. You can see the utility stocks and the consumer staple stocks have rallied when this is an interesting environment. So let's talk about this a little bit. So usually through a, let's call it 6 to 12 month lens. I'm not talking about here we're looking at a few weeks, a couple months of trading. But usually one can make the case that consumer staple stocks and utility stocks will at the margin, okay, do a little bit better than the broader stock market when the economy is doing less good. And that's because when the economy is doing less good, then utility stocks, which are essentially bonds, they act like bond prices, they will go higher because, well, bond prices are going higher, okay, to put it very simply. Consumer staple stocks, which will not see as much of a change in demand for their underlying business when the economy sort of drops, will tend to see, at least at the margin, some sort of marginal outperformance. Now again, this is through a time frame of like I said before, 3, 6, 12 months. Within a I should say it's 6 to 12 months or more. Within a 3-month time frame, a lot more things can happen, right? So that becomes less important there in the near term. But that's sort of what we're looking at here in terms of some of these indices. Okay. Now let's look at, for example, also a consumer. These stocks. This is material stocks, the XLB. Okay. So the XLB is the material stocks, and the material stocks are usually quite sensitive to things like the movements in the dollar, okay, and commodities, okay. So if commodity prices are going up, then we tend to see material stocks going higher, just like the energy stocks. When oil goes higher, energy stocks tend to go higher. So the XLB is also sensitive to the dollar. So if the dollar goes higher, material stocks at the margin, all else being equal, and assuming there's not a major move taking place in the underlying commodities, will tend to come under pressure if the dollar rises. So what I'm trying to tell you, and I know this is a lot to take in, what I'm trying to tell you is that by looking at the stock market sectors in the S&P 500, there's actually ways of trading many other asset classes in the world. Okay, so that's, to me, one of the great beauties about focusing on the U.S. stock market. Not only are there exchange-traded funds that represent different types of markets, like, for example, if you wanted to trade emerging markets, you could look at an ETF called the EEM. This is emerging market stocks, right? Just as a quick example. But what I'm telling you is that just looking at the S&P 500 constituent sectors, there are ways of playing different themes. So, for example, if you are very bullish on the US dollar, you probably don't want to be long energy, the XLE. You probably want to be maybe somewhat short. And in fact, I think the energy sector, I need to make a note here. This is interesting. XLE, I'm just making some notes here, is coming under pressure. So you can see that the stock market is not just a stock market in isolation, but there are other things happening in the stock market. The stock market is very much exposed to the rest of what's going on in the rest of the world, right? Commodity prices impact what the supply and demand for companies. So does currency movements, right? So the stock market is very much tied in with all the other commodity parts of the market, but you can't just buy stocks because you think the dollar is going up. There are different parts of the market that will act differently according to what's going on. Okay. Now, to answer the question here, there's a couple of questions, but ABC is asking the Russell 2000 and the S&P whether they are indicators of risk on, risk off. Yes, I mean that. To answer your question simply, yes, I would absolutely say answer that question with a yes. It very much has to do with respecting with respecting the relationship between stocks, large cap stocks and small cap stocks. Like I said before, I think there's a lot to be said about that. That's not something that a lot of people you know, who are new to the business understand, and this takes a little bit of time to understand. Okay, so now we've spent about 30 minutes or so going through this. Let me now walk you through a little bit, and again, we'll do this much more over the next 2 webinars as well. Let's kind of walk through these sectors and have a little bit of a look at what we can derive from the movements of these sectors so far today. Okay, so the U.S. stock market now today is open for 2.5 hours. Okay, so that's what, 150 minutes, if you want to be exact. And what we are seeing is the following. Let's just walk through it a little bit. So number one, you can see the S&P 500 here is essentially what we call flat, right? So it's not really doing anything. It's not going up. It's not going down. It's just kind of boring. Interestingly enough, the Russell 2000 is down 40 basis points, 0.4%. Now, that's not enough for me to freak out, but it's something that I want to respect. And in fact, I actually think this data may be a little bit delayed, so take that with a bit of a grain of salt. This may be like a 20-minute delay on the data. I'm not quite sure, but it doesn't really matter. The point is, let's just kind of go through the analysis, and you'll quickly pick up what I'm talking about. In fact, if I look at the S&P 500 right now live, the S&P is down 11 basis points, so not a whole lot different than what you're seeing here. And the Russell 2000 right now is actually down 50 basis points, so even further. So the relationship remains intact, right? You can see by what I'm telling you that things are quite weak. So let's continue. So you can see that the Russell 2000 is what we call underperforming the S&P 500, which is something that we like to take a note of. I don't think this today is enough to go ahead and freak out and sell, do all sorts of sell orders. Certainly not yet. But it's an interesting dynamic to watch, because we really haven't seen an underperformance of the Russell 2000 versus the S&P in a number of days. Industrial stocks, so let's pick at the weakest ones first. So with the weakest part of the market here today, you can see minus 1.3% is the transportation stocks, and the transportation stocks here are actually probably breaking below a 21-day moving average. Let me add the 21-day moving average. That's something that I like to use. So I'm going to quickly add in the 21-day, very simply like this. I'm going to make a 20 days, good enough, whatever. We'll make it a bit of a different color. So let's make it black, let's say. And, excuse me. Here we go. So here we go. Excuse me if the phone calls are coming through here. Anyway, so actually it's not yet breaking below. So the transportation stocks had been quite extended above all the moving averages, and so we are now just waiting for them to kind of consolidate. But what we're seeing here is the transportation stocks lagging today, which is a first warning sign, right? It's nothing to freak out over. But like I said before, we have the small cap stocks also underperforming. We have actually, excuse me, let me quickly do this here. Okay. And so again, I would raise a minor red flag here, and I mean minor, like just a little bit. Nothing yet crazy, but let's respect what we're seeing, right? Moving on, we see the technology sector, which is the XLK, which is basically the same as the QQQ, which is the NASDAQ 100, which is something actually we could add in here as well. So let's quickly add that. The NASDAQ 100, very, very important to watch. And this is probably something good to tell you as well. The NASDAQ 100 QQQ is very much related to the technology sector of the S&P, right? So that's the XLK, and really one of the main reasons why that's so. It has to do with the fact that Apple is such an important part of this market. If you keep in mind the trajectory of this one right now, and if we type in Apple now, you'll see that the chart looks very, very, very similar, right? So you can see that this chart of Apple looks almost exactly the same as that of the technology sector, for the most part. Of course, it's not this doesn't always true, but a lot of times they're very very closely related. Okay, so what we're seeing is technology remains strong. So today, if I look at the market today, as a very simple takeaway, I see a market that is struggling a little bit, but it's not really anything dramatic. Now, let's move on and start talking about what we might be able to derive from this market today. If we look at some of the more, let's call it some of the more exposed sectors that are a little bit more exposed to different parts of the, say, currencies markets, for example. Okay, so number one, we have, like I said, energy, and XLB, which is essentially your material stocks. Now today we're not seeing anything that is very much in line with what I would call interesting, but because today the dollar index is basically flat for the day. The dollar isn't really doing anything. So usually when you have a big move higher in the dollar, or let's put it this way, if you see a significant rally in something like material stocks or energy stocks, it's difficult to imagine that the dollar on that day has also had a very big rally. So you tend to see some sort of a correlation there. Okay? So now we've looked at all these things, and I hope it's given you guys a good initial idea. And again, we'll talk about this more on Friday and again next Wednesday. But I want to use the rest of the time today to look at some trade ideas. So number one today, we already touched on it a little bit before, is NVIDIA. NVIDIA is a trade idea that I mentioned it before real quick. I am actually bought a little bit of NVIDIA today. Again, that's not a recommendation. I'm just telling you that's what I did. And so just so you know, that's what's going on here. Now, if I look at NVIDIA, I see a company, a stock that continues to respect its 50-day moving average. That's that yellow line you can see right here. I think that yellow line remains very important. In fact, I just posted a video on my website. You can go to thesteadytrader.com. And check that out. So that's the THE steady STEADY trader TRADER.com, thesteadytrader.com. I just posted a video on a potential couple of trade ideas on NVIDIA. But you can see that we continue bouncing off of that 50-day moving average. Again, that's that yellow line. Now, to me, what I also see is that this stock has managed to hold above its 50-day moving average ever since actually almost exactly 1 year ago. Okay, so from my perspective, there's not a whole lot more important on this chart than that 50-day moving average. And I think that 50-day moving average, if and when it gets broken, and I say if because it obviously is not yet breaking below there, but if it does break below there, that would be I think quite a telling thing for the market. So just that keep that in mind. So right now we're looking at two things. I think it looks to me like that stock has kind of exhausted itself. Last Friday we saw follow through buying yesterday, and we are now looking at potentially being able to play that stock a little bit higher, maybe a few dollars, maybe to $115, $116. And then kind of take it from there. But if I look at NVIDIA a little bit further out, and this is where we look at the multi-time frame analysis that we talked about over well, when we talked about it at least a couple times over the course of these webinars, we had some buyer exhaustion take place here in late December and again a couple of weeks ago. So to me, the stock is kind of stuck, but on a near-term basis, it might be able to rally a little bit. But I do think there's a lot of resistance here around $120 in NVIDIA. So from my perspective, if the stock drops below 150, I think it's a short. Right now, maybe a bit of a trade, and 120 is a good area to play the stock short. There might be option strategies. I don't know if that's how many people are familiar with that or something that you want to do, but that's something that one could consider as well. All right, now let's look at some of the questions you guys have. Like one question here is on Apple. So let's quickly talk about Apple. For some reason that's not working. Here we go. So I think Apple continues to come into what I would consider to be a very precarious spot. So let's look at Apple. Let's look at Apple here on the weekly chart. Okay, and you can see that Apple is now basically surpassing what used to be these previous highs from 2015. Okay, so to me, Apple is now very, very overbought. I see really no reason to buy the stock here. I think what I'm looking to do is I'm looking to wait for the stock to consolidate a little bit. Maybe it's going to give us an opportunity to do something on the short side, but for right now, there's really not a whole lot. In fact, there's, in my opinion, nothing to do in the stock right now. That's kind of what I think about that. Then couple of trades you guys want to look at. So one of them is Dry Ships, DRYS. This is personally a stock I would never even consider looking at because it's trading at just a few dollars. So to me, I don't think this is a stock worth looking at. But nonetheless, of course, you have a question, so we'll look at it. I have no idea what to do with this stock. I wouldn't even know what to do. I have no idea. If you look at it on like a 5-minute chart, okay, we're bouncing now, but I don't know what to do with the stock. To me, this is a penny stock. I would never touch it, and I don't know how to trade this off a daily chart. If you want to know a day trade on this, maybe if the stock can get above $2.80, maybe you can trade it on the long side, but it really has to give you a strong bullish reversal for that to make sense. Moving on, MOMO. I think we've actually talked about that one in the past. I can't recall. MOMO. The concern about this stock is very much like Apple. I think it's very overbought here. So I would like to see either some consolidation going sideways, something like this. Oops, some sort of sideways move, or maybe even a strong bearish reversal where we can trade the stock to the short side. And then lastly, NUGT. This is a gold miners levered ETF. I think very much like the gold miners, you can look at something like the GDX. Okay, very much like the GDX, which I prefer to look at, but it's it's the same chart. I think we're starting to get into a territory here where maybe we have a trade to the short side because what we're now seeing. We have this consolidate. We have broken supports. Okay, that's this. So to me, I would argue that this is an opportunity to maybe trade these things a little bit lower down to the $23 area. Okay, this is the GDX, and I'm sure you can apply the same analysis on NUGT. Let's have a look at it real quick. Okay, so in NUGT terms, maybe that's closer to this part right here, which is what, like $10 or $9 in something. So that's kind of how I look at it. Okay. Now Tesla, of course, is going to report earnings today. That's true. What do I think? I don't know. I'm a long-term believer in Tesla. What I will tell you is first and foremost, what I think is important to understand is where Tesla is in the big picture. So I think Tesla is a great story going forward. I would never bet against the company long term. Jeez, what did I just do? Sorry. Let's look at it again on a weekly basis. Here we go. Okay. All right. So when I look at Tesla, I see this, and this is just the thing to keep in mind. I see this. Okay, this is the majority of the price action that that Tesla has been in. Okay, for the past, well, you can see it's been a long time. So by simple derivation, you know, what do you think? Do you really think the stock can sustainably break higher from here? I guess I'm asking the question, ABC Trader, to you, because you posed the question. You know, what do you think is the path of least resistance here for Tesla? Do you think the stock from here is just going to go straight higher and then break higher towards whatever $400, $350, or do you think, given the path here, it's may have to first consolidate a little bit? Right, exactly. He's expecting a mean reversion, and I think that's probably the path of least resistance. Now, the tricky thing right now is that we have earnings, right? So there's something very important to keep in mind when we talk about you know, expecting a mean reversion move, and that is that, you know, stocks can consolidate, or yeah, I guess consolidate is the best way to say it, in two ways. Okay, they can either consolidate in price, which is what we refer to as either a correction or a mean reversion move, in which case you would expect the Tesla stock to go lower, right? But stocks, particularly very strong ones like an NVIDIA last year, they can also just consolidate in time. Okay, and what does that mean? Well, it means that instead of going lower, they simply work off those overbought levels, those overbought readings, by just going sideways. Okay, and so it's important to keep that in mind when it comes to Tesla, that entirely is, it's certainly possible that the stock doesn't correct, but it simply goes sideways for some time. The reason why I think it's extremely improbable for Tesla to even, well, let's put it this way, even if Tesla, after earnings this afternoon or this evening and then tomorrow it gaps higher, even if the stock rallies to $320 or wherever it goes to, even if it does that, and it certainly can do that, but even if it does that, it has now traveled so steeply over the past few, couple months or so, that the likelihood of it breaking higher on a sustainable basis, okay, meaning that it's going to rally and then just keep going and going and going and going, is extremely, extremely unlikely. Most likely, the stock will do one of three things, okay? Either it's going to tomorrow gap lower or sell off, and then, at some point, hopefully we'll find another buying opportunity. Or it just kind of goes sideways for some time now. Or, lastly, it could gap higher because everyone loves the stock, and then within the next few days, weeks, whatever, it starts coming back and retesting at the very least this breakout level, or maybe even a little bit down here. So those are the three things that can happen. Now, you tell me, but given the fact that these three things are very likely, one of these things is very likely to happen, and I think each has an equal probability, okay, I really don't think you can say, you can look at the options market and say, okay, the options are implying X% move up or down. I don't think you can really say that there's a certain probability that the stock's going to do something tomorrow that's higher or lower for any one of these trades. Okay, so to me, the strategy for earnings is always wait for earnings to pass, wait for the earnings report to come by, and then we look at a potential trade. So this is something we can look at on Friday. Okay, we'll look at Tesla, see if there's something to do. Because right now, in my opinion, really there's not a whole lot worth doing here right now. So let's see here. Perfect. 1 second. Let me just look at one other trade idea here. . . Let's see, we wanted to look at one more trade idea here for sure. All right, so I guess one of the trade ideas I wanted to look at, again, all for example purposes, was in some of the banking stocks. So one stock that I want to look at here today with you guys is a company called CIT Group. This is not Citigroup. It's not the big bank Citigroup. It's also a bank actually, but it's called CIT Group. So CIT as a ticker symbol up here. And let's apply a little bit of the analysis. So let's first start off with the sector. So you can see if we look at the XLF, which is the financial sector, you can see that the financial sector today is holding up quite well, up 16 basis points. And so, you know, that's quite nice. Now, if we look at CIT Group, we need to look at it in a couple of ways. So first of all, let's look at it on a weekly chart, okay, which is something like this. So this is now looking back a little bit of time. Oops, looks like I messed this thing up again. All right. So what we're seeing here on CIT Group is this. We are seeing a stock that is coming into an important area of potential resistance and really something we need to watch quite closely. Excuse me. So it's coming into number one. See that red line right here, that where my cursor is at? Well, that red line is the 200-week moving average. So number one, the stock is coming into its 200-week moving average. Number two, you can see it's coming into this diagonal resistance area. Okay, that's this diagonal line. So this area right here, I'm going to highlight it. Looks like this. Okay, it's a little bit too much, but you can see what I mean. Basically like this. This area right here is very important. If the stock can manage to push above here sustainably, I would say if it can hold above, let's say $44 and change on a daily closing basis. Right now it's trading at $43.60. I think then this stock could be quite interesting on the long side. But again, you know, the reason why we're looking at it here through a longer term lens first is because you can see there's multiple things lining up: the 200-week moving average and diagonal resistance. Number two, or secondly, you can see that the stock here over the 2 weeks ago, for 2 weeks in a row, really tried to sell off. You can see it tried to sell, but every time it bounced off this black line. Well, that black line is the 20-day moving average, or a lot of times I like to use the 21-day moving average. Okay, and you can see it tried to push below there, bounced off it right away, 2 weeks in a row, and well, I guess it's the 20-week moving average, I should say. Okay, not the 20-day moving average, because we're looking at a weekly chart, as you can see right here. Okay, so so that's important, right? So this is giving us context that the sellers are quite exhausted, and it's giving us that additional sort of benefit of knowing that, you know, the sellers are exhausted. So if the sellers are exhausted, maybe there's enough buying pressure to finally push the stock above resistance. So let's move into the daily chart. And the daily chart looks like this. Okay, not a whole lot different than the weekly chart, but you can see here that we had an outside day. We call this, let me quickly get rid of that. We're talking about this day right here where the hand is right now, the cursor. You can see that was an outside day. And so that outside day has now basically led the stock to come into horizontal resistance. Again, we're just applying some basic multi-time frame analysis. So now the stock is really at a key spot, also on the daily chart, right? So let me see what else I want to tell you about the stock. Yeah. Okay. So you can see that Citigroup CIT Group, excuse me, is at a critical spot. Okay. So that's another trade idea here that I think is very interesting. And lastly, let's talk about Amazon.com. And I think for just a couple minutes, let's have a look at Amazon.com. First of all, let's have an understanding of where Amazon is trading here on the weekly chart, and you can see that the trend here remains very much higher. In fact, we just had a breakout take place yesterday. So let me show you what that looks like on the daily chart. Okay. So on the daily chart, you can see that Amazon.com, and let me draw in this, had a clear breakout yesterday, okay, right past resistance, and then you can see the breakout occurred after the stock has already now rallied quite a bit, and I do think the stock is probably going to get exhausted near term here very soon. But nonetheless, you can see that the stock has broken higher. So for me, this is one of those cases very much like Tesla and Apple, where the stock probably has to consolidate here pretty soon, either sideways or a little bit lower. Okay, that would also be possible that it kind of goes lower a little bit, and then ultimately, I do think this stock could continue to go higher. So, you know, that's another way, another stock that I look like. And so, if the key takeaway now, if you look at Amazon, if you look at Apple, or even if you look at Tesla, is that something that I tell my Clubhouse members every single day, several times, is that a stock has a very low probability of being able to sustainably break out and higher if it is coming to a breakout point like Apple from a very steep rally. So let me make this a weekly chart, so just once again you can understand what I'm talking about. Okay, so now we're on the weekly chart. So what I'm saying is that Apple here had a very important high take place in 2015. That's this up here. And now if we draw a very simple line of resistance, you can see that this ascent, or this assault almost, at these highs, even though it succeeded, has come at a very, very, very steep angle. So the chances of successfully continuing to rise at this level, at this rate, is extremely, extremely low. Okay, so that's all I wanted to cover, guys, today. Again, we'll continue with this on Friday, so the day after tomorrow. We'll talk about Tesla, see how that stock will trade after earnings. We will go through what I talked about here before about this kind of analysis, because I want you guys to understand how to look at the market through this kind of analysis where you look at the sectors and the small caps versus large caps and so on and so forth. So anyway, well, I hope this was helpful today. I'll see you guys hopefully on Friday, and I wish you a great rest of your day. Thanks for joining.